So Gavin, you're with a DFI that's focused on the private sector, but ultimately you work near exclusively with institutional investors because you're with the asset management team, and you lead that at the IFC. So sort of share with us your view on institutional investor sort of public partnerships, because it's always sort of perceived to be this call that, where there's a traditional PPP type project, when it sort of runs out of cash, the presumption is, well, long-term asset owners have significant assets, perhaps they can be topped up, without sort of realizing that there is a very specific set of criteria that needs to be pursued to be able to even consider investigating the possibility of investing in those assets. And then secondly, I'd just like your view on the 5% agenda and what you think asset owners on the continent could potentially put in place to be able to achieve a 5% allocation to African infrastructure in 5 years.
Great. Well, Hubert, thank you very much for having me. Okay. So, Hubert, thank you very much for inviting me. And first of all, I should say I agree with everything that's already been said. So, yes, we need to develop good projects. I think a 5% target for institutional investor allocation to infrastructure is great, not just for Africa, by the way, but particularly for Africa. I absolutely agree that we need to have creative intermediaries such as FONSIS who can look at things strategically and bring projects and capital together, and the whole sort of ethos behind NEPAD, et cetera. I mean, so I agree with all these things. Why have we, as IFC, created an asset management company? So as an asset owner, why did we feel that it would be useful to be an asset manager as well? Well, firstly, because we realized that, we have a limited amount of capital, and the way that we could have more impact and to make more projects happen was to also mobilize additional capital. And there are a number of ways of doing that. One way is just through debt syndications, which we've done for 50, 60 years. But we felt that particularly on the equity side, the best way to do this was to set up our own fund manager with a classic GPLP structure where we attract institutional investor capital. We've now, been doing this 8 years, and we've gone from kind of zero to now just actually, as it happens, last week crossed the $10 billion mark in terms of assets raised. This is 58 investors across 13 different funds. So it moves the needle a little bit, but it's mainly the demonstration effect of what we're trying to do is to show that a multilateral can be a financial intermediary and do so on a kind of proactive and profitable basis. And so one of the things that we've been looking at very much at the World Bank Group over the last couple of years as we think about, renewing our strategy, et cetera, is, what are the different ways we can do this? And I'll give 3 examples. Maybe one platform, one product, one policy. And so the platform is the asset management company, and what we have found in speaking to, because obviously we've spoken to lots of institutional investors who said no thank you, and we've luckily spoken to a number who've said yes, we're in, we'll invest. And it's a gross generalization, but what I would say typically is that people have not said we need more return. They've typically said we need less risk. So yes, of course, everything is a risk-return trade-off. But generally speaking, there is a perception that investing in developing countries, particularly in infrastructure, where all the capital is invested upfront before there's a single unit of revenue, is how do we, get comfortable? Okay, if it was a listed security, you'd want to see, a triple B minus rating if it was a bond. There are actually very few project bonds, so this is typically, private lending, which isn't rated, but that's conceptually what institutional investors are looking for. Now, one of the ways we found of doing that, aside from the asset management company, is in what we call our managed co-lending portfolio program. Some of you may be aware of this, and where we've tried to package together a series of infrastructure loans. And if, a typical loan that we make might be rated single B. I mean, typically they're a bit better than that, but let's just stick with this concept for the moment. If a typical loan might be single B, you package them together into portfolio, you can get maybe a double B, effective implicit credit rating on the portfolio. And then if we are able to provide a little bit of first loss protection, we can get it to triple B. And so this is what we've done with our MCPP infrastructure program. We've got 2 or 3 large insurance companies who are investing in this. And effectively, we've tranched the cash flows. And we and one other partner have taken, in a sense, the junior tranche. We feel very comfortable with that because we're the ones underwriting the loans. So we think this is very fairly priced. But it makes a huge difference for the insurance companies who could not invest in the package without tranching, but are very happy to invest in the senior tranche because we've provided this implicit. So this is an example of real risk mitigation. There is another type of risk mitigation.
Gavin, I just want to jump in here very quickly. Could or does that apply to projects that are pre-construction? I mean, you know, everyone's talking about how do you crowd in long-term capital to address this early-stage risk deficit. Do you think this model could apply to that, or does it already apply to that?
The model implies completely to that, because what we've done is attract them into not an existing portfolio. By the way, I think there's a quick win in just recycling some existing projects, but I mean, that's a one-off. Yes, of course, we should do that, but it's a one-off. What matters is getting the new capital for the new projects in the future. And so all of this, what the insurance companies, and there's no reason why pension funds couldn't do it as well, but it seems to have appealed most to insurance companies so far, what they have bought into is a future portfolio. So they're relying on us to underwrite it over the next X years. So they don't know what they're buying. What they're buying into is our underwriting process and our risk mitigation. But that requires real structuring and real risk mitigation. There's another aspect of risk mitigation, which is just dealing with the perception of risk, which is much cheaper, okay, which is just getting the message out. Moody's have done an analysis of 3,000 loans to infrastructure projects around the world. It's a bit dated now, as they did it 2 or 3 years ago. And they found that those projects in developing countries did not have a higher default rate than the projects in developed countries. And so actually, as it turns out, post facto, the risk was not greater. Okay? So one of the things we try to do is just get the message out that there's a perception of risk which doesn't necessarily apply. And the final thing I'll say is that country risk, regulatory risk tends to be uncorrelated. So for people who really care about reducing correlation across their portfolio, and we've seen what the problem is of correlations moving to 1 during the financial crisis, this should be an attractive asset class, particularly if you diversify it across very many countries, as opposed to what most pension funds and insurance companies do is they focus on either a small number of very large infrastructure projects or a small number of countries, rather than a large number of investments that are spread across subsectors and spread across different countries. And that, in a way, is how you get real portfolio diversification. And I think that would be a way of reducing the risk.
Thanks, Gavin. I want to stay with you just one more second as well. So you've managed to engage institutional investors. Some have said yes, some have said no. You've employed some fine mastery in terms of product structuring, and you've been able to address one of the age-old challenges on the continent, which is how do you move long-term capital into early-stage infrastructure. But I'd be interested to hear your views about, what policy changes do you think we're here right now during the World Bank annual meetings. Ministers of finance from all around the world are here. What would your message be to them in terms of how they can create a more hospitable regulatory environment to crowd in more pension fund capital into infrastructure, based on your experience?
So, Hubert, as I think you're aware, I'm a member of something called the Business and Sustainable Development Commission, which was set up after the UN Sustainable Development Summit a couple of years ago. And basically our job on this commission was to try and make the business case for the SDGs and the SDG case for business. And as we got into this, we realized it wasn't just business, it really was finance as well. And so part of it is awareness, okay, and you know, a need for business and finance to be aware of what the opportunities are, and we calculated a $12 trillion opportunity for those companies who help make the SDGs a reality. But we also realized there was an advocacy role for us in terms of speaking to governments. And you mentioned the G20 earlier. One of the specific things that has emanated from the G20, which will be 10 years old next year, is the FSB, the Financial Stability Board. And that's been quite a useful forum for talking about different financial regulation. And one of the things that we've perceived is that well-meaning, well-intentioned financial regulation in developed countries, Fed, ECB, you know, Bank of England, et cetera, you know, a lot of really good regulations on financial stability, anti-money laundering, CFT, you know, so on and so forth. But the net effect has been to reduce the flow of capital to developing countries. And so we're wondering whether, you know, we understand why, if your job is financial stability in Europe, that's what you need to focus on. By the way, there's also Solvency II as far as the insurance companies are concerned. But maybe these regulators should be given a mandate by the FSB to at least think about the consequences for capital flows to emerging markets, because we've just signed up 193 different countries to the Sustainable Development Goals. We've all agreed these are our global goals. So we should at least try and be joined up in how we set aside. So I would say the kind of what I would call the supra-regulatory system, or kind of the regulatory decisions that cross borders, should be looked at very carefully. I think that will have an obvious sort of positive effect. I mean, we see all the correspondent banking relationships getting reduced. That is bad news. We're going backwards on some of those things. So I do think that that is one area. And then the other thing we've looked at is we hear, we happen to have an insurance company on the commission, so we've spoken to them a lot, and they've said they would like to invest in infrastructure because they have long-term liabilities, so they need long-term assets. But the trouble is, a lot of regulations make it difficult for them to invest more than, you know, 1 or 2% or whatever. And so I said, I posed the question. I said, well, if the regulation was turned on its head, and the regulation said you have to invest at least 5%, as it happens. I mean, I didn't know about your 5% agenda here. At least 5% in infrastructure. I mean, would that solve your problem? So is it purely a regulatory problem? And then they go, oh, God, well, in that case, I guess we're back to our old friend, okay, where are the projects going to come from? So we can't solve this on one side, you know, only. We have to do both, okay? It's not either or. We've got to increase the supply of capital, partly through showing the risk is less than it is, and partly through really mitigating the risk. And at the same time, we've got to make sure there are good projects to invest in that have all the complexion that you need from a long-term asset that you're investing in order to ultimately pay pensioners or life insurance policyholders in 20, 30 years' time.
Absolutely. I think those are, you know, the real sort of key the key issues here. When we engage the regulators, well, listen, as far as we're concerned, perhaps the asset owners are overly conservative. Because we are not trying to prevent allocations into infrastructure. So maybe it's an overly conservative interpretation. The second thing they said is, we do not make regulation. We simply oversee its compliance. So if you really want to change the game, then you should be engaging with the ministers of finance to actually make the policy. And in terms of your, you know, the creation of your bankable pipeline of projects, most of them are responsible for the PPP units and the development of letting and bringing infrastructure assets to the market. So I think there is some work to do there, but it's good that. So
one quick PS, if I may. I see we have Philip Moss over here with SDIP, and you know, one of the things we also need to do a good job of is creating more of a marketplace where we don't have projects over here and capital over here. We sort of bring them together. That's part of the role we should do a better job of. It's part of what the Forum is doing with SDIP, and it sounds like it's exactly what you're doing also with the African Development Bank and NEBAD, et cetera. So that bringing together, creating the market where you can connect projects and capital is, I would say is a key objective.
Doing business in Africa, you can't afford to be without Africa Investor.